Hello, everybody, and welcome to problem 10-11. So this is asking us to look at three separate transactions. We're not going to be doing all the recording, but what they want to know is for each of the three transactions described above, determine what value which Klamath should be recording the acquired assets, support the calculations with an explanation of the underlying rationale. So let's go through and take a look at letter B. So on June 1st, I purchased equipment from Weygandt Corporation. I issued a $28,000 4-year zero interest bearing note for the new equipment. I will pay off a note in 4 equal installments due at the end of the next 4 years. So if it's a $28,000 note, installments are 4. The amount of each installment is $7,000. Okay. At the date of the transaction, the prevailing market rate for the obligations was 10%. So freight costs were $425, installations were $500, and then here are the factors. So the first thing is when I'm looking at this, is that the purchase price is not $28,000 because we have to impute interest. So the way I'm going to do this is I'm going to take my installment amount, which is $7,000. I'm going to multiply this by the present value of an ordinary annuity for 4 periods. Okay, it's not present value of $1. It's of an ordinary annuity of $1 because there's 4 payments at $7,000 each. So the value of the equipment is going to be 7,000 times 3.17 or 22,190. The other thing too is that when I'm talking about the acquisition cost, I also need to factor in the freight and then the installation. And the freight here is $425, the installation is $500. So my total cost of the equipment, which basically becomes my basis for depreciation and the like, is going to be $23,115. Okay, let's take a look at the next one. So for this next one here, it's kind of interesting. So Klamath purchased several assets of Yakima Shoes, a small shoe manufacturer whose owner was retiring. The purchase amounted to $220,000 and included the assets listed below. Klamath engaged the services of Tennyson Appraisal, an independent appraiser, to determine the fair values of the assets. So a few things here. Whenever we're buying anything, book value goes out the door. But now we've got the fair value. But the fair value is higher than what we're actually paying for it. So it's actually, instead of having goodwill, it's not necessarily badwill, but what we're going to have to go through and do is to allocate out the fair value. So over here, inventory, land, buildings, the fair value is 50,000, 80,000, 120,000. If any of you took me for cost accounting, for managerial accounting, what I went through and did was, this is kind of similar to the under applied overhead. Basically, I need to figure out what is the percentage of the total. So this is going to be 50,000 divided by 250, 80,000 divided by 250, and then 120 divided by 250. I multiply this by the purchase price, and this purchase price here is 220,000. So what I do now is I'm going to take so here my purchase price is 220. My allocation is going to be the percentage of the total times the purchase price. And just to make sure that I've done this correctly, I can add up my numbers here. So I'm going through and I'm allocating over here. This is going to be 220,000. So the amount that's being allocated to land is going to be 70,400. And then over here, the value of the building, land is 74, and then the value of the buildings is 105,600. Okay, so transaction 3. On March 1st, Klamath exchanged a number of used trucks plus vacant land adjacent to his plant site. Assuming 4 vacant land adjacent to his plant site. It has commercial substance, so we're going to recognize any gains. Trucks have a combined book value of 35,000. So this is the book value. And that means that if they recorded 20,000 of depreciation or total depreciation, that means that the original cost of the trucks was 55,000. So if we're taking these off of our books, the original cost of the trucks is 55,000. Okay. I'm also giving up cash of 19,000. Okay, so what do I do next? Well, to record the land, what I'm going to do, the value of the land is going to be the cash of 19,000 of what I gave up, plus the fair value of the trucks. And they're saying that the fair value of the trucks was 46,000. So the total value that I'm going to value this land for is going to be at 65,000. So in this part here, what I would end up with is I would end up having a gain of 11,000. I'm not being asked for that, but that's what it would end up happening. So my land has a value of 65,000, which is the cash plus the fair value of the trucks. Okay, now let's go back and answer some of these more verbose answers. The books of Klamath show the following additional transactions for the fiscal year ended May 31st. Acquisition of a building for speculative purposes. This is not property, plant, and equipment. In order for something to be property, plant, and equipment, we have to be using it in our business operations. If we're not using it in our business operations, it's an asset held for sale, and it's going to sit in current or non-current assets depending upon the disposal time. Purchase of a 2-year insurance policy cover plant equipment. This is normal operating costs. I do not put insurance into a typical insurance that's covering the plant equipment. That's an operating cost. Now, if it was special insurance for the shipment of getting the goods to me, that's different, but that's not what this is here. This is recurring over 2 years. Purchase of the rights of an exclusive use of a process used. So it's like a patent for the manufacture of ballet shoes. So this is an intangible asset. This has no physical substance. And so therefore it would be called patent or trade secret or rights, and then you would amortize it over the lesser of the legal life or the useful life. And then let's kind of go back up here because I kind of skipped the very first part of the question, which is plant assets such as land, buildings, and equipment receive special accounting treatment. Describe the major characteristics of these assets that differentiate them from other types of assets. We're using them in our operations for long periods of time. That's really, and it's being used in our operations. Another thing too is when it comes to, we're not going to be, because we're using generally historical cost, we're not going to be doing any kind of adjustments to fair value. they're not being held. And your book does a good job of explaining this. It says that the major characteristics of plant assets. So one, they're acquired for use in the regular operations of the enterprise and not resale. So we're not going to be concerned about what's happening to the value of these assets. However, as we'll note later, if the assets become impaired, that's a different situation. And another one is that property, plant, and equipment possess physical substance and are thus differentiated from intangible assets, such as patents and goodwill. Property, plant, and equipment do not physically become a product held for resale, unlike inventory or other items. And then these are durable and long-term and are going to be subject to depreciation unless it's land. And the only thing with land is depletion. And we're not living in North Dakota, so I'm not covering that today. If I end up teaching in North Dakota, though, I'd be happy to go through and do that. So that is problem 1011, and it brings a close to this over here. Have a great one, and I'll see you soon.